Everyone, Troy Eckard here with Eckard Enterprises out of Allen, Texas. Let's talk about peak shale oil. I believe many experts who are talking about peak shale oil do not have a clue what they're talking about. One of the things that is very important to remember is that the amount of oil we have left that can be drained from planet Earth has a lot to do with, and primarily to do with, the economics to recover, discover, and extract that crude oil. Here in the United States, we've relied on the last 15 years the new discovery of shale basins all across the U.S., utilizing modern technology of horizontal drilling and frac stimulations. We've gone from a country that was virtually out of oil and gas in 2008 at 3.8 million barrels a day to now we're a country producing 13.5 million barrels a day and the world's leader in crude oil production on a daily basis. That didn't happen because we sat around with our thumb in our ear. It sat there as an available opportunity, waiting for the economics to let go, the technology and the ability to affordably develop, harvest, and produce some of the lowest risk, safest oil and gas exploration we've seen in this country. So when we talk about peak oil and we talk about the fact that maybe these shale basins have reached the upper ends of their production capacity, my answer is hogwash. What we are doing is we're drilling the lowest risk, the easiest to develop, the closest to infrastructure, the least amount of secondary ancillary cost we can do, and what we can access and what we can produce from, because that's what commodity prices and the financial economics of today demand that we do. We're not dumb. We will drill the best wells at the cheapest price in the lowest risk areas closest to the infrastructure required to remove that as raw mixed material in the field to the refineries and to the customers in the United States of America. But if you were to ask us what happens if oil goes to $90 a barrel, is sustainable in the forward anticipation and the confidence of higher commodity price would do to the amount of oil and gas that can be produced, the answer is significantly different than it is today. If you further that by saying $110 a barrel, $150 a barrel, $250 a barrel, you might find that what today looks like a de minimis return, or that we've reached a bell curve and maximum output, is nothing more than a blip in the radar. This has nothing to do with anything different than any other natural resource. Copper, 100 years ago, had to be developed at the surface or in shallow mines. Today, they're going as much as 2,000 to 3,000 meters below the surface to look for copper because the buyer is willing to pay that much more to use the copper and buy the raw material required in mining copper. In other words, ladies and gentlemen, this is not about whether we have the oil and gas. It's about how much oil and gas can be produced and extracted today using today's economics. When they say drill, baby, drill, they just forgot a part of that phrase. It's drill, baby, drill, what's most economically profitable today, and drill, baby, drill tomorrow, what somebody's willing to pay a higher price for. Troy Eckard signing off. Hope you enjoy the commentary. Look forward to the next presentation. Take care.